There is something very strange about investing. Sometimes, the person who works the hardest is not the person who wins the most. The person who checks charts every single day. The person who wakes up before the market opens. The person who reads the news, studies candlestick patterns, chases trends, enters trades, exits trades, and writes down every move. After 30 years, that person can still lose to someone who does one very boring thing. Every month, he buys an index fund. Then he closes the app. He does not predict the market. He does not try to buy the bottom. He does not brag about winning trades. He does not have an exciting story to tell. But when you run the real numbers, the result surprises almost everyone, because the stock market does not pay you for being busy. Most of the time, it pays you for being patient. And in this story, we are going to compare three very common types of investors. One person trades every single day. One person swing trades for a few days or a few weeks. And one person invests in an index fund consistently for 30 years. All three of them start from the same place, but where they end up is completely different. Imagine three men named Tyler, Greg, and Ryan. All three of them are 30 years old. All three of them earn $75,000 a year. They live in the same city, they have the same income, and they have the same goal. They want to use the stock market to build real wealth and retire comfortably by the age of 60. Each of them invests $1,000 every single month. Nobody puts in more money. Nobody starts with a special advantage. Nobody has a secret shortcut. Over 30 years, each of them will put a total of $360,000 into the market. The only difference is how they invest. Tyler chooses day trading. He wants to beat the market. He studies charts. He studies candlestick patterns. He watches the market every morning, and he buys and sells constantly throughout the day. To Tyler, sitting still feels like missing an opportunity. Greg chooses the calmer version. He is a swing trader. Greg does not buy and sell all day like Tyler, but he still holds stocks for a few days or a few weeks. He tries to ride a trend while it is moving. Then he sells when the trend starts to weaken. And then there is Ryan. Ryan does something that looks almost too boring to take seriously. Every month, he buys a low-cost S&P 500 index fund. Then he closes the app. He does not pick individual stocks. He does not study charts. He does not predict the market. He does not try to prove that he is smarter than everyone else. From the outside, Tyler looks like the skilled one, Greg looks like the balanced one, and Ryan looks like the lazy one. But in investing, appearances can be very misleading. For the first few years, Tyler looks like the winner. There are weeks when he is up 4%. Meanwhile, Greg is barely moving. And Ryan's account looks almost exactly the same as it did before. Tyler takes screenshots of his winning trades. He sends them to the group chat. He talks about being green for the month. He talks about catching the right move. He talks about having an edge. And after a while, he starts to believe it. He feels like he has real skill. Every winning trade feels like proof. Proof that he is smarter. Proof that he is faster. Proof that he is doing what serious investors are supposed to do. And this is where day trading becomes dangerous. Not because it always loses immediately, but because it can make you feel like you are improving very quickly. You see results every day. You feel emotion every day. You have a story to tell every day. A good trade gives you confidence. A bad trade gives you something to fix. And the whole process feels active. It feels productive. It feels like work. But Ryan has none of that. Ryan has no screenshot to send. No big trade to talk about. No perfect entry. No exciting exit. He just buys the index fund. This month, next month, the month after that, year after year. His strategy is so boring that nobody wants to hear about it. At a barbecue, Tyler has stories. Greg has opinions. Ryan has almost nothing to say. Because I bought the index again is not an exciting sentence. But the real problem is not that Ryan looks boring. The real problem is that Tyler is looking at the wrong scoreboard. Tyler is comparing this week to last week, this month to last month, one winning trade to one losing trade. But that is not the scoreboard that decides who builds wealth. The real scoreboard is not how much you made today. It is not how good this week felt. It is not how impressive one trade looked on a screenshot. The real scoreboard is what your money looks like after 10 years, after 20 years, after 30 years. Because investing is not a game of who feels the most in control today. It is a game of who keeps the most wealth over time. And that is why day trading is so dangerous. It gives you the feeling of control. The more you trade, the more you feel like you are working hard. The more decisions you make, the more serious you feel. But working hard in the market does not automatically make you richer. Sometimes doing more just gives you more chances to make mistakes. The first problem for Tyler is taxes. When you buy an investment and hold it for more than a year before selling, the profit is usually treated as a long-term capital gain. But when you buy and sell in less than 1 year, that profit is usually treated like ordinary income. In simple terms, every time Tyler wins and closes a trade, he may have to give part of that gain away to taxes in that same year. And that matters more than most traders realize, because that money could have stayed inside the account. It could have kept working. It could have kept compounding. But instead, it gets pulled out of the game before it has time to grow. And taxes are only the beginning. There is also the spread, there are fees, there is slippage, there are tiny losses Tyler barely notices on each individual trade. One trade leaks a little, one day leaks a little, 1 month leaks a little. And by itself, each leak looks harmless. But when you repeat that process hundreds of times a year for 30 years, those small leaks are not small anymore. They become a hole in the bottom of the bucket, and that hole slowly drains wealth. The dangerous part is that Tyler does not feel like he is losing money. He feels like he is taking action. He feels like he is learning. He feels like he is reacting quickly to the market. He feels like he is becoming better. But in the background, taxes and costs are quietly taking away the most powerful force in long-term investing. Compounding. Compounding needs time. Compounding needs money to stay in the account. Compounding needs peace. But constant trading usually does the opposite. It keeps cutting profits into smaller pieces before those profits ever get the chance to grow into something bigger. Greg looks at Tyler and thinks he is smarter. He is not staring at a screen all day. He is not buying and selling hundreds of times a year. He is not living with the same level of stress as Tyler. Greg is calmer. He is more patient. At least, that is what it looks like. Greg only holds his trades for a few days or a few weeks. He tries to follow the trend. When the market looks strong, he buys. When the trend starts to weaken, he sells. And compared to Tyler, this sounds much more reasonable. And to be fair, Greg does have some real advantages. He pays fewer trading costs. He deals with less slippage. He spends less time watching the market. He is not trapped in front of a screen from morning to afternoon. So yes, Greg's strategy is better than Tyler's in some ways. But the biggest problem has not disappeared. It has only become quieter. Greg is still trying to predict the market. He still has to decide when to get in, when to get out, which trend is real, and which trend is a trap. He still has to be right, over and over again. And most of Greg's gains are still short-term gains. That means he is still not getting the full tax advantage and compounding advantage that Ryan gets. Greg is the kind of investor who can easily fool people. He does not look reckless. He does not look like a gambler. He is not trading like crazy. He looks like he has a plan. He looks disciplined. He looks more mature than Tyler. But a strategy can look reasonable and still lose over time. That is the uncomfortable part. Looking disciplined is not the same as building more wealth. Moving slower is not the same as moving in the right direction. Greg loses less than Tyler, but he is still losing ground to Ryan. He is bleeding slower, but he is still bleeding. Ryan is the least exciting person in the group. He does not have colorful screens. He does not have winning trade stories. He does not have market predictions. He does not have the feeling that he is smarter than the crowd. Every month, Ryan does one simple thing. He buys a low-cost index fund. Then he closes the app. That is it. No drama, no perfect entry, no perfect exit. No big opinion about what the market will do next. And from the outside, this looks almost too boring to matter. But that boredom is exactly Ryan's advantage. Ryan wins because he almost never sells. And when he does not sell, he does not constantly create taxes. His money gets more time to stay in the market. His gains get more time to create more gains, and that process continues quietly for years. Ryan also wins because his costs are low. One index fund can own hundreds of large companies in a single investment. He does not need to pay for hundreds of trades. He does not keep losing money to spreads. He does not need to pick the right stock every week. And maybe most importantly, Ryan wins because he does not let his emotions control him every day. Tyler has to fight fear and greed constantly. Greg still has to make decisions again and again. But Ryan reduces the number of decisions to the minimum. And in investing, fewer bad decisions often lead to better results. Ryan does not win because he is the smartest person in the room. He wins because he lets the system work. He wins because he does not interrupt compounding. He wins because he understands something most people ignore. Sometimes, the best strategy is not the one that makes you feel smart. It is the one you can actually stick with for the longest time. Now look at the results. After 30 years, all three men invested the exact same amount of money. Each of them put in a total of $360,000. Nobody added extra cash. Nobody started with a bigger advantage. Nobody had a head start. But the final results are not even close. Tyler, the day trader who bought and sold every single day, ends with about $511,000. Greg, the calmer swing trader, ends with about $812,000. And Ryan, the man who simply bought an index fund and closed the app, ends with about $1.778 million. Ryan has more than 3 times what Tyler has. He is ahead of Tyler by almost $1 million. And that gap becomes even more painful when you count time. Tyler spent about 2,000 hours a year watching the market, preparing trades, entering positions, exiting positions, reviewing what went wrong, trying to improve. Over 30 years, that adds up to about 60,000 hours. That is almost like working a second full-time career, a second life spent in front of charts. Greg spent less time than Tyler, but even Greg still spent around 10,000 hours over 30 years watching trends, managing trades, and making decisions. And Ryan? Ryan spent about 4 hours a year, a few minutes each month. Over the entire 30 years, Ryan spent around 120 hours total. That means the man who worked the most ended with the least money. And the man who worked the least ended with the most money. That is what makes this story so powerful. Tyler did not lose because he was stupid. Greg did not lose because he was lazy. They lost because they were playing a game with too much resistance, taxes, fees, friction, emotion, and the pressure to be right again and again. Ryan won because he chose a simpler game, a game with fewer leaks, fewer decisions, fewer mistakes, and a strategy that actually worked with time instead of fighting against it. Because in investing, the best strategy is not always the one that feels the most active. Sometimes, the best strategy is the one that lets time do the hardest work for you. The lesson here is not that nobody should ever trade. That is not the point. The real lesson is that trading should not become the main plan for your financial future. If you want to trade because you enjoy learning, because you like the feeling of the market, or because you see it as a hobby, then keep it small, very small, maybe no more than 5% of your portfolio. Something you can afford to lose without damaging your future. But the rest should be built with things that are much more boring. Low-cost index funds, consistent investing, a long time horizon, and discipline, because the market does not care how hard you try. It does not pay you for the number of hours you spend in front of a screen. It does not reward the busiest person. For most people, most of the time, the market rewards the most patient person. The trap is not trading itself. The trap is mistaking activity for progress. And sometimes, if you want to win in investing, the hardest thing is not doing more. It is learning how to do